It's really excellent to have you with us, and thank you to SGX for hosting us in this fantastic setting. It's wonderful to be meeting in person again. Had lots of serendipitous little chats of the sort that we've missed out on over the last 2 or 3 years for all the obvious reasons. And certainly I found it heartening to bump into long-standing contacts over the last couple of days by chance, which is a useful reminder. I don't think we needed one, but a useful reminder of the benefits of taking the trouble to travel that we all took for granted when we lost them for a while. I think it's also a sign, dare I say, of Singapore's growing status as the preeminent and financial hub in ASEAN. That really is very noticeable to someone who hasn't been here for a couple of years for all the reasons that we know. We are trying to make use of what the disruption taught us. We've got people with us, hundreds of people with us online today, so that wouldn't have been true 2-3 years ago when we were last here. And we also got used to convening the right people globally in a way we couldn't before COVID, of course, which has changed how we all work. And we've got today, as a result, a really excellent mix of banks, asset managers, central banks, multilaterals, rating agencies, government officials, academics and others, both here in the room and digitally worldwide. So thank you all very much for your engagement and for coming along today. A lot else has changed too since 2019, of course, when we last ran a public event here. That was a time when developed world central banks were scratching their heads about how on earth they could ever generate inflation, for example, with plenty of our key pundits at OMFIF claiming that that was essentially impossible. So be careful what you wish for, perhaps. We'll also explore some of the major economic developments in a moment with Prakash Kannan of GIC. Looking forward to that. And my colleague Clive Horwood will take you then through our recent research on how public investors are dealing with the kind of stagflation which would have sounded completely outlandish just 2 years ago. The same headaches apply, of course, in general to wealth managers at a time when wealth management itself seems to be on the move, including towards Singapore. So my colleague Lily Zhu will be taking a look at that with her panel later this morning. Likewise, CBDC was a really esoteric term before the COVID era. The disappearance of cash transactions sped up policy discussion about how money works and how new technologies like DLT and Web3 will interact with existing financial structures in future. We're launching a report on that a bit later in London called Future of Payments, so do check that out. But again, Singapore is at the heart of that discussion. MAS was among the pioneers to start thinking about it among central banks, and we're hearing from Sok Mendu and others later on today. You'll see us taking on other key areas where the official sectors and private sectors really need to keep talking. How should sustainable finance finish its transition to the mainstream? Do listen to Tamara Singh and her panel on that. How will multilateral development banks in Asia navigate that, as well as the incoming financial stress in recipient countries that's likely to follow rate rises and recession? So do listen to Clive Horwood take his MDBs through that discussion a little bit later. They're all global themes, of course, but have very different expressions in ASEAN compared to elsewhere. It's a rather unique, complex and heterogeneous area, as I think you'll agree, but one which is now leading the world on these topics. It really is our pleasure to bring you together in Singapore to talk about them in the state-of-the-art exchange with an excellent and diverse set of panelists. It's our style to involve attendees in the discussion, so do get your questions ready. We like to engage the audience, so do start thinking about anything that you want to ask, and we'll engage you as much as we can as we go. And it's off the record, so we would like people to be as frank and open as they can possibly be to facilitate the most useful discussion. So thanks again for joining us, to SGX for helping facilitate this conversation. And indeed, we'll hear from its CEO, Boon Chye, in a little while. Firstly, though, we would like to tour the economic horizon as GIC sees it, and in the form of Prakash Kannan, who's Chief Economist, Head of Total Portfolio, Macro and Markets, Economics and Investment Strategy. So Prakash, please come to the stage. Morning, Prakash. How are you?
Morning, John. Thanks.
Yeah, good to have you with us. plenty for us to talk about. I thought I'd start with the thing that drives all other things in financial markets, namely the Federal Reserve and what we expect to be going on in the US economy. Equity markets seem intermittently relieved that the Fed might be slackening its tightening cycle a bit. We've seen what some people think are bear market rallies in the US, and the economic data are pretty confusing and mixed. You've seen a slight slackening of inflation, but pretty tight employment markets there too. So what's your view on where you think the US economy is heading? And then we'll go and explore the others as well.
No, thanks, Sean. Always the easiest question to to kick off the session. Look, I think the way we see it is you can categorize the shocks into basically three categories. So you have an interest rate shock, you have a kind of a real economy shock, and then you have actually what happens to liquidity. I think our view is roughly on the interest rate shock, you are probably about 85-90% done. And this is with regards to both what's priced into the market, but also in relation to where we see inflation dynamics. I think the real challenge is going to be the next two elements. So the real economy, I think, actually has been relatively resilient, but we think that is going to turn, and the bulk of it is going to be felt in 2023. And then you have the third element, which is really what's been happening on the Fed's balance sheet, as well as the low transactional liquidity that you're seeing. And I think these last two elements are what I'm particularly worried about for 2023. If you look at equity markets, I think one interesting pricing element that's happened is, so if you define the equity risk premium as the difference between earnings yield and the real interest rates, actually what you're seeing right now in US equities is the equity risk premium has actually come down, which means that it's the impact of real interest rates on equity markets has been the primary driver. And so a declining equity risk premium is really not the kind of dynamic you would expect to see in a recession. So what I think translates going forward is that once you get that second element, which is the impact on the real economy coming through, you're going to get earnings revisions coming down. And I think that's going to push risk premium a bit higher. So still a little bit more cautious, I think, at this point.
During the IMF World Bank meetings a couple of weeks ago, there was a complicated argument about whether the inflation data are going to significantly lag what's going on in the real economy, and therefore encourage central banks to oversteer in the direction of managing inflation and create a harder recession than is necessary. What do you think about that risk in terms of lagging inflation data and central bank pressure on them to respond when actually the job might already have been done?
Look, I mean, inflation has traditionally always been a lagging data. I think the initial communication that had me a bit worried was you had central banks making policy statements on spot inflation. And I think if they were reacting solely to inflation data as it came out, I think then that risk of over-tightening is definitely there. You are seeing at the margin some change in the conversation that's coming out of central banks, in the sense that they're going back to the old way of doing things, which is actually talking about forecasts. And I think that if you are in a position where central banks are making policy on the basis of forecasts, then I think you are actually on a better trajectory. So, for example, when Chair Powell said that he would like to get wages down to roughly about between 3.5% to 4%. So that takes an underlying rate of productivity growth at about 1.5%, and then inflation at roughly between 2 and 2.5%. So I think that gives you a sense that actually, when he thinks about inflation, he is actually thinking about, in a way, a more steady state or a forward-looking inflation. I think if you were looking at spot inflation, then I think the risk of doing too much definitely increases.
Do you think that we understand employment data post-COVID? There seems to be something that's quite complicated that's happened in developed world economies where people have disappeared from the workforce for various reasons. In the UK, a lot of people retired early. Elsewhere, there are people with long COVID and so forth. Do you think that the labour markets might be structurally tighter than before COVID, potentially, in these markets?
No, that's a very good question, and interestingly, it has been a phenomenon that's crossed a lot of markets. In fact, even here in Singapore, you have these job openings relative to the unemployed. That ratio actually being one of the highest it's been at least for like 20 or 30 years. I think the uniqueness of the reopening dynamic, I think, is also part of it, where you have a lot more pressure in low productivity services jobs, which in general tend to be more labor intensive. And then I think you have some of the secular forces as well. So one thing which we have been looking at for a long time is really the impact of demographics, and the aging of the population, even in the UK, but even in continental Europe, even in China for that matter. I think a lot of it has been brought forward. So if you look at the labor force participation data, particularly in the US, actually for the prime age workers, let's say 15 to 65, that's actually come back to where it was pre-COVID. Where you are actually seeing a lot of the labor force participation coming off is in the older cohort, and that's where we think some of the more kind of permanent scarring impacts from COVID might be there.
What do you think the long-term impact of demographics will be on rates? We had a presentation from Andrew Bailey, Governor of the Bank of England, a few months ago, which was quite a complicated and technical speech designed to manage inflation and interest rate expectations in the UK. But he used a presentation to suggest that there is still a long-term pressure downwards on rates because of demographics. Would you agree with that?
Yeah, so one of the biggest drivers of interest rates at the end of the day is still going to be nominal growth. And I think nominal growth tends to have, well, by definition, it has two components. It has a real component and it has an inflation component. I think on the real component, one of the biggest drags down in trend growth has really been the aging population. So if you look at the US, at the start of 2000, US trend growth was about 3.2%. Now, if you look at the CBO estimates, even the Fed estimates, trend growth in the US is down at about 1 3/4. Large part of that is demographics. If you look at China, first half of 2000s, China was growing at 10%. Second half of 2000s, growing at 8%. Now we think actually trend growth is even down to 4%. And once again, that contribution of human capital and labor to Chinese trend growth, even this decade, is already down to 0. So because of all of that, you have real growth actually coming down. And so the pressure for real interest rates, I think, continues to stay low. I think where it could get a bit more interesting, I think, is in inflation dynamics. And this goes back to actually your question on the labor force. I do think that both because of demographic pressure as well as, in a way, bigger societal pressure in terms of moving the pendulum away from capital back to labor, we think that the pressures on wages are going to be higher going forward. And so that I think net gets you to a nominal growth trajectory, which is slightly higher than where we were pre COVID, but definitely lower than where we were, let's say, in the early 2000s.
Okay, I want to come back onto China again in a moment. You've just talked about that. I mentioned in my remarks just a minute ago that 2-3 years ago we were talking about the impossibility of creating inflation. It's been created for all the reasons we understand. But there were complicated discussions then, particularly in Europe, about negative policy rates, let alone real rates. Do you think we'll be back in those discussions within the next 2 or 3 years?
Yeah, well, and I mean, I guess never say never. But I do think it is a very telling sign that even at the depth of COVID, the European Central Bank did not cut interest rates. In fact, they resorted much more to balance sheet policy. So I do think that even if we do go back there, there is a sense that negative 50 basis points, which was how low the ECB went on depo rates, was some kind of an effective lower bound that you have there.
Yeah.
I think policymakers are quite happy to see the back of negative nominal rates. I do think actually long-only institutional asset managers are also quite happy to see the back of negative rates. I mean, at this time last year, you had about 40% of the sovereign bond index that was trading negative. Right now, you have 5, and all of which is in Japan. So you are seeing a very different fixed income market. I think you are seeing some return of value, and I think both policymakers and politicians in general, I think would want to preserve that in some sense.
You'd expect them to work very hard not to be pushed back into discussing it again in the near future.
I think no one. I mean, look, central banks cut interest rates not because they want to, but because they have to. And the situations in which they cut, in general, do not tend to be good environments. So, I mentioned those 3 things. You had rate shock, fundamental shock, and a liquidity shock. I think what I worry about is actually that third part, where you end up actually with some financial stability issue, and I think that's where you end up getting those very sharp cuts. If you do have a mild recession, which is our baseline scenario, it's likely that central banks may not cut that a whole lot.
Okay, back to China, and if you've got any questions for Prakash, I'll turn to you in just a second. That we talked about, you've talked about China already and the long-term demographical impact that is unfolding there. For the last 20 years before COVID, of course, China was a major component of world growth after it joined the World Trade Organization. And it also, of course, helped keep inflation down in developed markets because of the cost of goods coming from China. Do you think all of that has now permanently changed, or will we go back to it as China finally gets out of its COVID crisis?
I don't think that permanently changes. Look, I mean, China is still about, depending on how you want to measure it, somewhere between 16 to 20% of global GDP. But it has at the margin contributed about 40% to global growth. So even as trend growth in China comes down, you're still working off a much larger base than you were in the past. So we think China still continues to be that growth. I think what's really unique about this cycle is just that you do have an opportunity where Chinese assets are, at least relative to historical average, pricing in, I would say, a relatively cheap pricing. And on top of that, I think you do have a phenomenon where Chinese assets are very lowly correlated with the rest of the world. And I think from an overall portfolio construction perspective, there is a certain appeal, I think, from that dimension.
You're describing China actually somewhat as a useful hedge, I think, potentially.
Yeah, I mean, it's just kind of at a very different point of its cycle compared to where the rest of the markets are right now. Okay.
Any questions so far from Prakash, and then we'll have a look at the European economy as well. Questions for Prakash? Put your hands up. If not, let's talk a bit about the European economy. It's struggling, of course, with the cost of energy, which Europe largely has to import. Do you think it's been fundamentally damaged, the European economy, by the Ukraine conflict? We listen from a lot of pained voices in Germany, where they've lost cheap energy imports and export markets all at once, potentially. Albeit there are mixed data, and a lot of companies seem to have managed to get by with less energy, but still deliver the same output. What's your take on the European economy?
Yeah, look, I mean, as well, you definitely, John, know, and as some of the members of the audience, I've been a big fan of the European project for a long time, and I think that to me, it's one of the big successes, I think, in really trying to get a bunch of sovereign nations together to work on a very meaningful project. The rumors of kind of, as in your phrase, I believe you said fundamentally damaged. I mean, they've always been greatly exaggerated. And in fact, I think even in this episode, along with COVID, along with Brexit, I think you have seen Europe moving a lot closer together. But I would say, though, that the challenges are going to be very extreme. And I think the central challenge with Europe that has always been there is just that even in the face of global shocks, the impact on individual economies are just very divergent. So you have inflation dynamics that are just very different, north to south, east to west. And you also have actually the structure of financial markets being very different. So the degree of informality in some markets like Italy, the sensitivity of mortgage interest rates, depending on whether it's floating fixed, very different across different markets. So I think at the end, the challenge for Europe at this point is always going to be, are there adequate risk-sharing mechanisms that can make sure that you don't get this kind of divergence pulling these countries apart. I think the way that Europe came together with Next Gen EU during the COVID crisis is just a wonderful example of using existing institutions to generate that risk sharing mechanism without having to go to treaty changes, etc. So I think I continue to be confident that Europe will continue to find these kind of solutions, but it's not it's not going to be easy.
Let's explore Next Gen EU just briefly. It is an interesting project, and we shouldn't underestimate the amount of political will that it required in places like Germany to have this kind of burden sharing in Europe. And there are even signs that it might be working. So the Italian growth rates are hugely outstripping German ones at the moment, which is useful because it was the other way around for a large portion of the Euro project, creating strain in the project via Italy. Do you think NGEU is going to work?
Well, I mean, I think, as you said, it is actually already working, and I think the linking the disbursement of particularly grant money to structural reforms that are being done on the ground, I think is actually a great way of getting all the incentives well aligned. In fact, I would say even the TPI instrument that the ECB has put out. Sorry, there's a lot of acronyms in one breath. But the TPI instrument is basically the ECB's mechanism to try and avoid unnecessary spikes in sovereign spreads that kind of impede the transmission of monetary policy by the ECB. And I think the way that they have done it, I think, is also another really clever way, which is that number one, the ECB itself can trigger this clause, right? So it's not as yet another acronym, OMT, in the past, where you needed the recipient country to be the one to ask for assistance. So here the ECB gets to trigger the clause. But second, it links back the criteria back to some of the similar things of having your budget in the right shape, having your macro balance procedures all in the right position. And so I think you are getting to a much more kind of better institutional structure that helps alleviate that risk sharing problem.
One of the outputs, of course, of the Ukraine crisis is the enrichment of energy exporting countries. How are you and GIC thinking about that and those countries in economic terms?
Right. So I think you have seen a big windfall, if you will, for a lot of the energy exporting countries, and in some ways, this has transferred some of that assets to their sovereign wealth funds. I think it's a great opportunity, particularly for some of the Middle Eastern countries, to implement some of these transformation programs that they've been talking about for a long time. The interesting thing, I think, for passive investors at this point is that the Middle Eastern and North African region is not going to be a trivial portion of the emerging market equity index that's run by MSCI, right? So even if you take Saudi Arabia is going to be somewhere between 4 to 5% of the index. All of MENA 10 to 11%. So even as a passive investor, you can't ignore these markets anymore. And it's not just all one big play on oil. I think there are very interesting domestic stories that are going on, and so actually we do see it as an interesting opportunity.
Finding it just on our world tour, people used to talk about BRICS and the Indian economy a lot more in the past than they do now. But I think you're positive on the Indian economy. Tell us why.
Yeah. So look, I mean, India. The common story I say is that there are very few markets in the world right now where you could actually have a credible story about revising trend growth upwards. And I think India is one of those economies. So we have trend growth at about 6.5%. So if you take inflation at about 3.5%, 4%, you have trend nominal growth at 11%. It's just very hard to find a kind of a large economy that's actually going to be growing at that rate. And then on top of it, you have some of the longer trends. So one trend which we've been looking at is the energy transition story, and I think India has been really making a big push into the renewable energy space. You have a big push into the digital infrastructure. So the universal payment interface that India launched about a couple of years back has really kind of, in a way, made the transfer of government payments to citizens, etc., or even between individuals, much more efficient. And all of this, I think, is done on the back of much cleaner banking as well as corporate balance sheets. So there's a lot of positive things, I think, to say about the Indian economy. I think the unfortunate thing is that if you look at where the scarring from COVID is the deepest in India, it's all in the informal economy. And at least estimates by the ILO as well as some of the own Indian authorities, you see that in the informal economy, labor force participation has fallen. Degrees of kind of labor utilization in general has also fallen. So I think that I think is the one part that I think will linger on a little bit, but it is a market that we are very optimistic about.
Interesting. In our GPP survey, a global public pension survey, which my colleague Clive Horde is going to talk about in a little while, we unsurprisingly found a move to risk off overall among those institutions for all the worries about inflation that we've been talking about, essentially. Would that be a realistic characterization of GIC's overall position at the moment? And if not, how would you characterize it?
Yeah, I think, risk off is a very it's a strong word. I mean, we're still cautious. I think primarily because I think that those other two legs, I think that I talked about, have yet to fully play out. I think you could make a credible argument that inflation has peaked, but where we are a bit more cautious about is that even though it has peaked, we think it's likely to be a bit more persistent. And so as it comes down, the fact that it stays above most central banks' targets means that the pressure for keeping rates higher for longer, I think that's going to continue to be there, and that's going to weigh on risk assets.
So you do think that there is a risk of oversteering from policymakers?
Well, not so much oversteering, but we think that actually because inflation stays very persistent, the incentives for central banks to actually start cutting rates, I think, is going to be very low.
Okay. Anyone got a question for Prakash before I wrap up? Please raise your hand if you'd like to ask Prakash a question. Last one from me then. Are you worried, Prakash, about the process of deglobalization for all the geopolitical reasons that we understand and don't need to go into here and now? Will reduce economic potential in general in the world, both in terms of growth but also productivity, as people talk about friendshoring and reshoring, would have Adam Smith turning in his grave. Do you think it will reduce the global capacity of the economy?
Yeah, I've never really liked the word deglobalization. I don't think we are necessarily stepping back. I think that, but the nature of globalization, I think has changed, and I think we have probably a very well informed audience here. So I think we know a lot of the changes that have been happening. And yes, it is going to be negative for efficiency. It's going to be negative, or in a sense positive, I guess, for inflation. I will throw in maybe one silver lining, which I think is that where we've been trying to pay some attention at the margin is actually on the globalization of services. And I think that because of remote working, because of increase in technology, I think there is an area of globalization that has actually, in fact, continued to motor on strongly, and this is actually in the cross-border trade of services. So it's an area we're paying close attention to and trying to see ways in which we can invest in it. But we think it is actually a trend that's continuing despite the kind of negative headlines I think you would see about deglobalization.
Prakash, thank you very much. It's always fascinating to talk to you. Looking forward to talking to you again. So please join me in thanking Prakash for his insights into the global economy today. We'd like to introduce now the CEO of SGX, Boon Chye, who's going to make a few remarks. So over to you.
A very good morning to the OMFIF team and everyone here this morning. It is indeed SGX Group pleasure to host the OMFIF Asia Forum in Singapore again, and thank you for this opportunity to speak. We last hosted this forum back in 2019, and so many unprecedented and unexpected events have happened around the world in just 3 years. Prakash has provided a very useful perspective, and in fact was round the world, look into the macro environment and the global economic outlook. It was also not too long ago when everyone was talking about lower rates for longer. Winds have since changed very quickly to higher rates for longer. The global economic slowdown and persistently high inflation rates have become topmost concerns on the minds of global investors. 2022 is also said to be one of the worst years for institutional investors, surpassing the global financial crisis and the pandemic. The newly launched OMFIF Global Public Pensions Report offers deep insight into the investment plans of some of the most influential investors globally. The title of the report, Flight to Safety versus Flight for Returns, cannot be more apt in describing the balancing act that investors face in the current environment. In keeping with the forum's focus on Asia's role in this new generation, I would like to highlight 3 themes that I believe will drive capital flows now and into the near future. Firstly, Asia will continue to evolve and grow. And Prakash talked about China and India earlier on, and it would serve global investors well to constantly relook at this region as part of their portfolio strategy. Asia remains a relatively bright spot in the global economy and is also in a sweet spot to benefit from investment flows. The region has a host of favorable factors, and its diversity presents numerous growth opportunities across countries, asset classes, and sectors. In a separate OMFIF survey earlier this year with reserve managers, Asia Pacific was picked as the favored destination for further investment. More than 33% plan to increase their allocation and exposure to this region. While this figure was a dip from last year, it was the highest proportion for any region. Asia as a region is also complex with idiosyncratic risks. These risks have to be carefully managed, but also capitalized on to achieve the returns that investors are seeking. Investors' barbell strategy of flight to safety and flight to returns is what SGX Group is well placed to support. As Asia's most international multi-asset exchange, We've built a marketplace that allows global investors to have seamless and unfettered access to almost 100% of Asia's economies. Our trusted ecosystem, anchored in Asia's only AAA rated jurisdiction, has attracted higher global investors amid uncertain and volatile markets. This is reflected in the new highs achieved for our total derivatives average daily volume across asset classes this year. The latest Global Public Pensions Report has interestingly noted that global public funds are turning bearish and more defensive on China. Quite a lot was spoken early on in the conversation, amidst concerns of market transparency, the regulatory environment, and capital controls. I, however, remain upbeat on the prospects of China. China remains hugely important and is expected to drive long-term growth despite short-term headwinds. A vast majority of the respondents continue to hold Chinese assets. This means that investors would still need to manage their risk exposures, even though they are increasingly pessimistic. Access across asset classes is important in navigating changes in such an investment landscape. SGX is recognized globally as the one-stop multi-asset platform to trade Chinese assets and manage risks comprehensively across equities, bonds, currencies, and commodities. Market participants can express their views through our pioneering SGX FTSE China A50 futures or SGX US dollar CNH futures contract. These are the most liquid international benchmarks for the China market and the most widely traded RMB futures respectively. Market participants can also invest through the world's largest Chinese pure government bond ETF listed on SGX, which has AUM of about US 1.5 billion, or in the growing suite of Chinese-focused ETFs. Commodities are also a key investment proxy for the macroeconomy. With the world's biggest marketplace for seaborne iron ore derivatives, our flagship iron ore contracts are used by market participants as a barometer of the Chinese economy. Notably, SGX Group is a strong proponent of strategic partnerships to enhance connectivity with Chinese onshore marketplaces. Later this month, we will launch our two-way ETF link with Shenzhen Stock Exchange. This link is just one example of several that were established between exchanges to bridge and increase capital market flows across borders for the markets in Asia. This brings me to my second theme on refining capital flows. In the current market environment, investors are actively managing their portfolio to both preserve capital and hopefully achieve returns. Deep liquidity is key in today's volatile markets. As we speak with our customers, some have told us that choosing the right trading venue with deep liquidity is sometimes more important than the choice of trading instruments. I believe that connecting and bridging different pools of liquidity comprising diverse investor profiles will deepen liquidity, enhance capital flows, and in turn increase investment opportunities. A case in point is in the foreign exchange market, the largest and most liquid market in the world. Currency risk is a key consideration for investors amid uncertain and volatile market conditions. SGX has been working on better supporting the FX hedging and trading needs of OTC and futures participants with efficiency and liquidity. Specifically, we are aggregating liquidity pools for OTC and futures participants via an integrated and scalable FX platform. We've recently launched an FX electronic communication network that connects global participants anonymously to unique and deep OTC FX liquidity pools. I believe this is the direction of travel for capital markets, the coming together of capital across venues, whether it is OTC and futures, or in the case of equities, across public and private markets. The same principle can be seen in our commodities markets, where the coming together of physical and financial market participants has resulted in vibrant and liquid platforms for hedging and investment opportunities. My third and final theme is none other than ESG and specifically climate change. This is an area that investors cannot ignore. In the medium to long term, climate change is seen as global public fund's most important concern after inflation. Asia Pacific accounts for half of global greenhouse gas emissions, and many Asian countries are highly vulnerable to climate hazards. These economies will need significant financing to reduce emissions and adapt to the physical impact of climate change. Government financing alone cannot meet the pressing climate financing needs. Mobilizing private capital on a large scale would be necessary to achieve climate goals. However, financial markets alone is also insufficient. Instead, we need to consider how we can reshape transition finance by combining both public and private capital. One opportunity lies in public institutions such as global public funds and sovereign wealth funds, as well as philanthropic entities, coming together to catalyze and crowd private capital to fund transition financing solutions. This provides the unique advantage of enhancing the risk-return profile by reducing investment risks and attracting greater financing. This is already playing out in Singapore, a growing hub for family offices and foundations which have the capacity to do good given their long-term view and their flexibility in allocating resources. The Monetary Authority of Singapore is working with private banks, family offices, and foundations to crowd in philanthropic capital to attract a wider range of capital for this purpose. Across Asia Pacific, 9 out of 10 family offices are involved in philanthropy, while about half have made sustainable investments in their portfolio. XGX Group recognizes its position at the center of the market ecosystem, and we are complementing these efforts, facilitating the flow of capital towards climate transition. By working closely with other stakeholders in the ecosystem, including index providers and institutional investors, we can drive capital flows by creating investment vehicles such as ETFs. We continue to build a portfolio of sustainable and transition finance solutions across asset classes. As the leading international green bonds listing venue in Asia, we have today more than 360 green, social, sustainability, and sustainability-linked bonds listed on our platforms. And in the past year, almost 20% of all bond listings were GSSS bonds, with more than 50% of those from Asia Pacific in G3 currency listed on SGX. And also on the index front, our subsidiary Scientific Beta has created Climate Impact Consistent Index, the only pure climate index offering on the market that allows investors to promote real-world emissions reductions. We also plan to launch products based on MSCI climate action indices, which covers companies that are taking concrete steps to reduce their carbon emissions. This complements our existing suite of low carbon ETFs. A credible carbon credits market and exchange is also necessary to support price discovery for carbon. Our joint venture, Climate Impact X, offers a global marketplace for quality voluntary carbon credits. Robust carbon pricing will lead to more investments in low carbon projects, facilitate a more transparent market, and support investors in making informed decisions. And according to the OMFIF report, the lack of relevant and accurate ESG data remains a key barrier for global public funds to further adopt ESG. On this note, I'm pleased to highlight that together with MAS, we have worked with multiple stakeholders to launch an ESG data disclosure portal called SGX ES Genome. This portal allows companies to report ESG data in a structured and efficient manner, and for investors to access such data in a consistent and comparable format. In closing, the only thing that is certain is the uncertainty that investors will continue to face in the foreseeable future. For global investors to stay the course, keeping to long-term investing principles will be crucial. There's no better time for the public and private financial sector to gather and discuss the path ahead for global investments. I wish you all a fruitful gathering and conference. Thank you.
Thank you very much indeed, Boon Chye. It feels absolutely right that we are hosting this Asia event here at SGX, and thank you for allowing us to do so. This really does feel like the heart of Asia's financial markets. I'm always enormously impressed with the range of initiatives and proactive plans that SGX has. It's so much more than just an exchange, and I'm sure if you can play any role in helping to close the ESG data gap, Boon Chye, not just Asia's financial markets, but the global financial markets, will be very, very happy indeed, because it is certainly an issue. Boon Chye kindly teed up a little bit about what I'm going to talk about now. In a moment, we're going to have a panel of some leading investors and economists to talk about how markets and macroeconomics are affecting investment decisions at the moment. But yesterday, or sorry, the day before that, we actually launched our Global Public Pensions Report. We did two pieces of work with global public investors over the course of the year. We have a survey of reserve managers, central bank reserve managers, and then we have one of public pension funds and sovereign funds, which is what we launched this week. And I'm just going to take you through a few of the key findings of that, ahead of teeing up the conversation that we will have at the panel shortly. So, just to give you a quick introduction, it includes a detailed survey of global public funds, pension funds and sovereign funds. We had 19 respondents, not a huge number, but a huge amount of money under management, and it's a very global sample. It covers Europe, North America, Middle East, and Asia Pacific. That is supplemented by research we do of the annual statements for over 100 pension funds and 50 sovereign funds, and our focuses this year included on asset allocation, ESG, operating models, and data. So let's talk about risk. Prakash was talking about some of this earlier. Let's look at what are these funds most scared of? And clearly the two overriding factors here are the global economic slowdown and inflation. But it is interesting, if you look at the fourth bar on this chart, it is interesting to see how many are worried about tighter monetary policy as the most important factor. And I think that came to some of the stuff that John and Prakash were talking about earlier of will global monetary policymakers overreact if we are starting to see the end of inflation. So that gives you a sense of the risk background that investors are dealing with at the moment. We talked about the name of the report is, or the title of the report is Flight to Safety versus Fight for Returns. You see it very much in this chart. You can see the top three are effectively inflation hedge trades to some extent, moving and seeing a lot of money moving into areas like real estate and infrastructure, and also, of course, inflation-linked government bonds. Those are the three areas that we're going. So we see sovereign funds a lot in real estate and infrastructure, not so much global public pension funds. So that's a new move. To be expected, there is a move out of equities and falling equity markets. A pretty neutral view on government bonds. I think, as Prakash was saying earlier, you'll probably start to see a turn back towards government bonds at the high yields now that they're offering, and a shift out of corporate bonds and a real shift out of cash. Not much point in having cash sitting on the sidelines in a market like this. So a real shift out of cash. And this is almost like a barbell approach, maybe, that some sovereign funds and pension funds are taking, adding some slightly less liquid, maybe higher risk assets, while trying to maintain elements of liquidity in the portfolio.
So you see here the inflation hedges of the top three, the net decrease in some risky assets in the middle, and looking to put cash to work. Currency allocations, and no surprise in times of global market volatility that we see a move towards the US dollar. Also, a slight move towards the euro. I wonder whether some of the efforts that Europe has made, that we talked about with Prakash earlier, are having a positive impact there. And look further down, we see a move out of sterling, not really surprising given what's been going on in the UK recently. But for the first time in a report that OMFIF's done of global public investors for quite a long time, we do actually see not a positive view towards RMB allocations, but a negative one. So we don't know whether that's a long-term trend or a short-term trend. It might be affected by China seemingly starting to open up again. We have seen, and I heard the other day, that there are actually quite a lot of funds, particularly on the private banking side, high net worth clients, moving back into Chinese equities. But that's something maybe we can talk about on the panel later. Why are public funds bearish on China? It won't be too much of a surprise that geopolitics plays a large part in that. But there are also, the things that China has not solved for some time: market transparency, the regulatory environment, capital controls, and so forth. So things that China needs to act on if it wants to re-engage maybe with international investors. We saw in the research we did of 2021, we saw a 3% rise in allocations to the foreign portfolios of public pension funds and sovereign funds. And this is quite a long-term trend, particularly of pension funds in smaller economies with large savings that the domestic markets just can't actually fulfill all of their investment needs. You might have thought at a time of uncertainty there might be a bit of a repatriation. Not going to happen according to this. Still moving towards more increase in foreign holdings over domestic going down a little bit. So that seems like a long-term trend that hasn't been changed by recent market upheaval. Any fund is looking to produce as many returns as it can in difficult circumstances. So we asked, are you going to grow your yield-enhancing activities? And the answer is yes. Growing securities lending, expanding collateral management activities, growing through the use of hedging, e.g. through derivatives and so forth. I mean, 35, 40% don't expect any change. This is interesting. It's investors trying to put their money to work in new ways. It also brings risks. You'll have seen, no doubt, in the UK, the liability-driven investment debacle, although that actually was probably more to do with a unfit-for-purpose UK government communicating badly with the market. But it's just something to keep an eye out. But obviously, public funds trying to move into some of these areas. We talked about ESG, big commitment to investing in renewable industries, also a big commitment to investing in transition and in green and other sustainable bonds. But less than half saying they'll reduce their investment in fossil fuel industries. So proactively moving into some good things, but not necessarily getting out of the bad things. We talk a lot at the moment with public funds about data. Managing efficiently your portfolios is even more important at times like this. The data challenge remains a big one. So you can see here a clear desire to improve data systems. 85% saying that they need to build or improve internal data management systems. More than half saying they need to obtain new or better data sources. But the issue is managing the data, aggregating the data, analyzing the data, rather than necessarily finding new sources of data. That's the key challenge that public funds face, and I think most firms operating in financial markets at the moment. They have difficulties in integrating new technologies. Again, nearly 70% say that the top technology challenge is integration. You won't be surprised to see that security, including cybersecurity, is also a big factor. Costs as well, easily overlooked. If you're going to have state-of-the-art systems, they cost money. You've got to hire good people. You've got to hire technologists. There's a lot of competition for technologists. Can big public funds or central banks compete in that area? They need to, as you can see here. And just a little reminder about how the world has changed. The research that we did, the year-on-year change. So these numbers are actually end 2021 numbers on the right, rather than the end 2020 numbers on the left. But 2021 was a great time for public funds and sovereign funds. Lots of inflows, lots of high returns. So I think it was about 20% that the overall network of the top 150 public pension funds and sovereign funds grew. over the course of 2021. We don't expect to see those numbers when we do this report next year. The report is available to download. If you're listening online, go to the website. If you've got a brochure here, in the brochure, there's a QR code you can scan to download the report. Do take a look at it. Do give us feedback. It's an important piece of research for us. We're very proud of the results we get. We're also very proud that some very sensitive data and information is shared with us by some very important institutions. So thank you to all of the institutions that took part in the survey. With that background now complete, we're going to move on to our panel. So the conclusions here, I think we've done. So let's move on to our panel. Thank you for listening to that. And can I invite to the stage our panelists, Yugis Khatri from Nanyang Technological University, Trevor Persaud from AIA, Ashwin Sanketh from Nikko Asset Management, and also joining us, hopefully, by the miracles of technology virtually, we should have Nazaful Effendi Zainal Abidin from QOP, who is a few hundred miles up the road in Kuala Lumpur. Hopefully he is about to join us on the screen. There he is. Hi, Nazar. Good to see you there. I'm going to now transition over here. Thank you, everyone, and thanks. Welcome to all of our panelists. Thank you for being here today. Let's start by sharing your thoughts on some of the things that have been raised in the research that we just showed. But maybe I can just start also with you, Yugesh, to sort of like tell us, whether that reflects your thinking in terms of what the markets are, and also great to get your macroeconomic perspective as well, both from an Asian and global point of view.
Yeah, I'd agree with a lot. I'd agree with much of what has been said, including with Prakash and your survey. It's actually a little gratifying in the sense of I think you saw the paper we wrote in mid 2021. Joe Cherry and myself, we were a paper called A Turning Point, where we thought inflation was coming. We went through the reasons why and the kind of things we said to do in light of that. Linkers, talked about moving to real assets, and what wasn't up there was quality convertible. So it's very, very consistent with what we thought. Now, I guess kind of if I can spend a minute on what I think is likely to happen going forward, I think the caricature of what happened, I think, is now well settled. We had demand side shocks, demand side pressures, supply side, right? And if we look across the regions, the US, I would argue it was more than half demand-driven inflation. Europe, probably a third demand, 2/3, the supply stuff. And Asia, I think we are the delta on inflation above and beyond, the targets is mainly, I think, the supply side stuff. So that's the characteristic. So I wouldn't be too worried in the sense of as the food and fuel prices come off, as I guess is expected in futures prices, etc. Asia is going to do okay on the inflation front. And we're seeing downside supply. I don't follow the data as closely as I used to, but I think Korea surprised on the downside, Thailand and others in terms of headline inflation. So that's consistent. Now, where I guess I thought I differed from the market was I thought US inflation would be more persistent. I thought there's going to be a deeper downturn in Europe and the US than perhaps markets were pricing in, and therefore lower for longer. But I feel that more and more conversations I have with markets, and more, I think that's becoming also embedded in expectations. So I can go through at some point if you're interested why I think will be higher for longer, not lower for longer, higher for longer. And so what does that mean for Asia? I think I'm expecting actually the dollar to strengthen again. I think that's a non-consensus view. And I think that hits Asia. We've so far used a lot of reserves to, push back against bigger depreciations. We have a fairly large feed through from, FX to inflation. So we push back, but I think there's going to be a limit to how much more Asia is going to do in terms of using reserves. So I think the stronger dollar is going to be a challenge. And I think in terms of inflation implications of a weaker than expected US and Europe means actually deflationary pressure for Asia. So that's kind of two offsetting factors: stronger dollar, but deflationary impact from the export demand.
Just to ask you though a little bit deeper on that, you think we'll be higher for longer on rates?
Yes,
but you think that fears about inflation for the long term are slightly overblown, or
no,
okay,
no. I think near term, I think if you look at market expectations and if you look at I don't know, even the WEO, the IMF, World Economic Outlook, what I've noticed is watching at every data point for the last year, since probably around late last year, you have an inflation outcome and you have the market consensus from there onwards is down. The IMF WEO again down, and every new data point was higher, and there was always an. So I think there's been some amount of systematic underestimation of the underlying inflation pressures and persistence. I think there's still some of that there, but it's encouraging the more conversations I have. What Prakash just said, it's encouraging that kind of more persistent inflation is now getting priced in, I think.
Okay, thank you. We'll come back to this, I'm sure. I want to make sure we bring Nazar in so that you feel part of the discussion. Sorry, you're joining us virtually and you can't be here in person, but it's great to have you here. Nazar, tell us a little bit about QOP. Obviously, the survey that I just presented, you are one of these big public funds. So it would be interesting to sort of like hear a little bit about QOP, and also just to get your views on the markets that you're investing in now. And during the course of the conversation, we'll go into a lot more detail, I think, on the particular investment decisions and approaches. But to get your overview on that would be very helpful. Thank you.
Thank you, Clive. Hi, everyone. Yes, just like to give a bit of introduction of what QOP is all about. We are the second largest pension fund in Malaysia, the largest public pension fund in Malaysia. We manage funds to the tune of $35 billion US. We've been established in 2007, and I think in terms of our exposure overseas, abroad, we have presence in 40 over countries, covering a multitude of asset classes. But to the survey that you just shared, Clive, I think we are in concurrence with most of it. I think for us, the challenge is to diversify Malaysia. We are currently exposed. We currently have a fairly high exposure in the domestic front. On the domestic front, 90% of our assets are invested domestically. We intend to move that down that up to 30%. We are currently around half that target. To the point in terms of outlook, I think the house view is we are fairly cautious. I think the word you use, cautiously optimistic about next year. We echo with the findings. In fact, the word recession is something that we talk about since the beginning, middle of this year, in fact. And we anticipate that could be a headwind for next year. But on the being a long-term pension fund, I think it's important to emphasize that we are here to stay the course. We are bound to face these noises or macro noises every now and then. So I think for us, we look at it from a long-term standpoint. Being a long-term patient capital, we can afford to do that. We think at some point next year, there could be an inflection point that I think we might need to reread some of our views in terms of the asset class that we're invested in. We're quite diversified. I mean, to the question you asked earlier, we have exposure in private markets. We intend to increase that for obvious reasons. And I think that's the reason why we believe that there's opportunities across asset classes. But at some point next year, we do think that there could be an inflection point. We think dollar might be experiencing some downdraft, maybe later part of next year, as the Fed begins to become a bit less aggressive in terms of the monetary policy. So in a nutshell, we are always mindful of the opportunities as well as the risks going to 2023. But then again, we are still very focused in terms of cost. Being a pension fund, we have targets to meet, and we want to be able to sustain the trajectory for growth going forward. That's my short answer to the question, Clive.
Thank you, Nazar. I think we'll come back in a little bit. It'd be interesting to go into a little bit more detail on how you will build those foreign assets and where you're looking, because I think that's very, very interesting what you said. And we're very lucky on this panel that we have a diverse group of asset owners and asset managers. So, Trevor, maybe I could come to you next. From AIA, obviously a hugely well-known and very large insurance company with a particular liability-driven, I guess, approach to investing. But before we go into too much of the individual detail of where you're investing, how are these change markets affecting your overall approach? And what do you think are the sort of the short, medium, and long-term challenges that you face?
Yeah, thanks, Clive. Is this on? Yeah. So, yeah, I mean, by way of explanation, I think it's useful in terms of background as well. As you say, I mean, from an insurance company and asset owner perspective, our role in the investment universe and our investment program is relatively straightforward. Right? We have assumptions that we make around long-term returns. We price on the basis, we price our borrowing effectively on the basis of those assumptions. And so if we hit those assumptions, then we make our margins, and anything above that is pure profit. Right? So we're incentivized to get our assumptions correct and make sure the precision around our investment program is in place. And then, as a secondary point, we're interested in generating alpha, right? And motivated to generate alpha. So if that's the context within which we're organized, I think to your question, maybe stepping back a bit in terms of investment strategy, I think the fundamentals that are often discussed around what should be driving markets, I think the last few years have shown that they don't necessarily reconcile with the timing of those impacts in terms of what we see working through prices. And I think that's the difficulty in terms of assessing inflation and the turning points that we're expecting. So over the last few years, so some would say with the benefit of hindsight that luckily we went pro-growth significantly in terms of tactical asset allocation post-COVID, literally from the point of March. And one of the points that was reflected in your survey is that we have invested significantly in improving our agility in markets through the use of derivatives. Half of our book in total is 200 plus billion, but half of that's in US dollars. And so that market's deep enough for us to operate in size in both the derivatives as well as the cash markets. And so we were able to take positions which were pro-growth and benefit from the pro-growth rally post-COVID, whilst at the same time managing our risk using derivatives in terms of at the margin putting in protection and ratchets around the gains that we were making. And so that capability worked well as markets became more dynamic in the last 3 years. Now, in this last year, I'd say as inflation continued to rise, as was observed, even though most commentators, including the Fed, had identified it first of all as transitory, but also had been expecting at least a reading of this inflation print coming off, both at a headline and a core level, and that taking longer than expected to come through, affected our short-term views, so our tactical views around interest rates and equity returns. I think also, you know, from an economist perspective, the reaction of equities, if you were simply to run historical analysis of what happens to equities when rates rise, you'd expect equities to do well until the very end, right? As those rate rises start to impact the economy. The dynamic of most equity indices is one explanation of what we saw happen, being more growth oriented in terms of their biggest holdings and their biggest weights, and therefore the greater impact of rates on equities at an earlier stage is how we reconcile the fact that equities moved in a different way than we expected. Now, just reverting and giving you an opportunity hold me back in terms of just continuing to walk down this road of strategy. This point about liability driven being the core of what we do means that even though fixed income is tanking, correlations are high, and so equities are tanking, that's not necessarily a bad thing for an insurance company. Even though inflation is high, right? It's not necessarily a bad thing for us. Interest rates being generally high is not a bad thing for an insurance company in the same way as it shouldn't be for banks. So we're into the second iteration of like, okay, how does that affect our long-term return assumptions? And I think other factors such as ESG, such as long-term impacts of post-COVID, etc. Those are the things that we need to start thinking about in terms of the first fundamental I mentioned, which is whether our long-term assumptions make sense. And then the question around tactical positioning is really about whether we think there are trending factors that we can take advantage of because we're so large, or whether we just sit through and manage where we are from a fundamental perspective. And so we were risk off, using the term that came up earlier. We went risk off late, with the benefit of hindsight in markets, but say around mid-year. And we went to cash, right? Because we didn't like bonds, because we still thought that there was still room to go on interest rates, and we expect that still to go from where it is now. And we didn't like equities because the chances of recession have been increasing, right? And we don't think that the impact of earnings coming off has yet been reflected, which is a fundamental point. And so as of now, we're looking at the fact that and I think it's well priced, that interest rates will peak in the next 3 to 6 months, and we believe that's true. And so entering into, and I think most of our competitors and large investors like ourselves are thinking the same thing, which is now is the time to start thinking about taking back duration. And so part of the liquidity impacts that we'd seen in the market was that no one wanted to buy bonds. We're buying bonds. The large investors who were short rates have started to unwind those trades, and you're seeing that in the short-term move back down on rates. So, as I said, I could keep going. But
just interestingly, so all the cash that you went into cash to go risk off, are you now all back into the market with all of that, or still have some higher cash positions?
Yeah, and look, so we can't go all into cash.
Yeah.
So we would have, there's operational issues about holding too much cash, and we'd have limits on that. But yeah, we went to and past our limits on cash holdings. We're now buying back into bonds, both government, because our expectation with a recession coming is the credit spreads will blow out, right? But also locking in some of the corporate credit rates that we can see now. So we weren't big fans of IG for about a year in terms of increasing our allocation, but yeah, those are the things we're buying. We're not yet buying back into equities, and we're still technically running an underweight position in it.
Okay, well, we'll get into a little bit more on those asset allocations. I just want to bring Ashwin in. We're very lucky to have one of the largest private sector asset managers in Asia with us today, Ashwin, Nico. Talk us through quickly, just your overview of how you feel the investment environment is, and some of the core decisions and challenges you're making at the moment.
So, just for perspective, Yogesh is looking at it from an economics perspective. Trevor's looking at it as an absolute return fund manager or asset manager. We tend to do a bit of both absolute return and relative return, but by and large, we are looking at relative return. So we're trying to beat a benchmark, whether that's an Asia Pacific benchmark or a MSCI global benchmark, or whatever that is. So that colors the perspective for sure. In general, I agree with Yogesh that I don't think Asia has as much of a risk from sort of persistent long-term inflation issues as some of the other regions around the world will. At the end of the day, if you look at inflation as a sort of a net transfer of value from a net consumer to a net producer, I struggle to see a world in the next 10 years where Asia is not a net producer. So I don't see that as an overtly large risk. And going back to what you showed on those slides in terms of the findings of the survey, I mean, the other thing I've found in my experience is when people talk a lot about certain issues, they tend to be less boogeymen than it's usually the stuff that's not being talked about that tends to bite you in the backside, right? So I'm less of a worrywart when it comes to sort of inflation in Asia. With having said that, I mean, there might be short-term cycles where you have, inflation go up a little bit for a couple of years and then come back down, etc. But fundamentally, I'm not bearish, and we do see demographics as a big factor in that, because at the end of the day, labor factor productivity in China, even over the last decade, has gone up at an annual rate of 16-17%. Right. Yes, the absolute cost levels have gone up, and they are switching to automation where possible, because now that cost parity with a robot has come true. So there is some of that, but there are other pockets in Asia where manufacturing moves too. So we're not so concerned that Asia becomes affected by this in the medium term. In the very short term, yes, I mean, there is obviously contagion risk from demand slowdown in the West. You'd be naive to assume that doesn't come through. But there are, large domestic economies like the Indias and the Indonesias. We're not in the camp where we think China is uninvestable. We do think it is investable. There have been, commentaries out there that, Xi Jinping's consolidated power, it's a one-man show. I mean, you'd have to be really living under a rock to believe that it was anything but that for the last decade. I think it just sort of formalizes the fact that you have one figurehead who's in power. But, you don't have to like the political system to understand that it means that there will be political stability over the next decade. So net, if you sort of look at the largest economies in Asia, you look at the Chinas, you look at India, you look at an emerging economy like Indonesia, we're actually quite positive on all those pockets. Right? Where we are concerned probably more so are Taiwan and Korea, because they're much more geared to Western demand in terms of the exports. So that's the sort of the short view.
So I mean, Trevor said that he's not back into the equity markets yet. You run a big equity portfolio. What case would you make to Trevor to say now's the time to get back into equities?
I mean, so I don't know if there's a hidden question there, in the sense that you're asking an active manager if it makes sense to be an active manager. And I think the answer is a resounding yes, right? I mean, I'll just give you an example. If you look at the Korean market EPS, earnings per share, over the last decade and a half, it's probably flatlined or slightly higher. So if you were a passive investor, that's what you'd have got, right? But that doesn't mean you couldn't have made money in the Korean equity market. So I don't think you have to. And the other thing about being a passive investor is obviously, it makes sense in large, deep, liquid markets. Asia is not that. The other thing is, I mean, obviously Asia is going through massive change, right? I mean, you have different political systems, you have different economic stages of economic development, different wealth levels, different things going on the ground in different parts of the world. So I don't see that as amenable to a passive strategy. So from that perspective, the issue is not one for us of saying, do we want to dip our toes in equities? It's which equities do we want to own? Do we like, for example, companies that get nickel out of the ground? Because I mean, the world's talking about ESG. We've heard that already from multiple speakers. You can't have electric vehicles without nickel. And yes, it's a dirty business, but at the end of the day, the nickel's coming from Indonesia. So if you say, well, I want world to get clean and green, but I don't want to own an Indonesian nickel mine, that's a bit silly. So we find that as an attractive opportunity. So we like that sort of space. Again, different markets, different stories. I mean, you look at India, there's so much happening that, Yogesh talked about it. We've had, Prakash talk about it. The domestic growth story is there. And for the first time in probably 25 years, you can actually say it's not a hope story, right? Because India has always been that hope story where everything's just around the corner. But, you've actually seen traction on the ground now.
Yeah. And you see that as well, Yogesh. And also just on that sort of like longer term equities question, if you believe that Asia Inc. and Asian corporates are going to do okay, then you would be into the equity markets for the long term. And kind of just to check, I just had a message that our audience listening in virtually are struggling to hear every now and again, so we can keep the mics up to the mouth and project as well.
Right. So the question is long equity Asia?
Yes.
Yeah, I think that's a no-brainer. I think you have to get back into equity. It's very painful to be in cash. So we're all looking for the right time to kind of get back in. I think for the reasons my panelist and Prakash mentioned earlier, I'm particularly optimistic about Asia. India and Indonesia resonates with me. I spent a lot of time working on Indonesia as well, so I know it very well. For the obvious reasons, big domestic markets, less reliant on external demand, demographics still good versus, let's say, China, reforms starting to take place in both cases, and a look to digital transformation and kind of laying the infrastructure for that. So I think long term, that's where the growth is, and long term, what drives equity returns, it's going to be the macro factors growth. And so hence, yeah, for sure. I had in my GIC days, famously kind of did support the overweight EM. We were very overweight EM, and at that time I had already tilted away from overall EM to Asian EM, and I think that's kind of turning out to be the right call.
Okay, thank you. And let me come back to you, Nazar. You mentioned earlier a shift towards more foreign holdings. Tell us how you're approaching that. If there are particular asset classes that you're looking at, or particular geographies, and also, that's quite an operational challenge as well, I guess. So how are you approaching that?
Yeah. I mean, thank you for that question. I think the struggle for us is to be able to diversify into asset clusters that we believe would generate the alpha. And in that context, we are trying to build our portfolio within the private market space. It's quite challenging. We are curtailed by certain regulatory restrictions. So we continue to look into private equity. Is something that we are consciously very excited about. And I think recently we've also started to think about private credit. A meager allocation, but something that we believe could provide us that features that could actually withstand certain macroeconomic backdrop. You mentioned about inflation, something that we are consciously thinking about. So to move that from where we are currently in terms of public to private markets ratio of about 80 to 20 to 75 to 25, it's a tall order because it is, after all, private markets. And within PE, I think the emphasis so far has been predominantly non-Malaysia because the opportunities within Malaysia are few and far between. We have got quite a fair, quite a balance in terms of the growth and buyout space. We want to build exposure within the VC and perhaps going forward, going more direct. So yes, it's quite tough for fund like us to actually move into these markets, and I think more importantly is to be able to convince our stakeholders in terms of what this asset class offer in terms of the long-term returns and potential. Our conviction is very solid, so we believe this is a time for us to move into these asset classes. We continue to actually diversify the exposures within this asset class into specific themes. Property is also something that we think about, and consciously we are increasingly embedding the ESG element as well in terms of our strategy going forward, Clive. Short answer again.
And to what extent, Nazar, are you using external managers to help you with that transition?
Okay, so the transition, and for the public markets, we believe the ratio is about 80-20. We outsource to 20% of our AUM to external fund managers. But for the private markets, I think predominantly is we use funds to access those opportunities. We do have collaborations with some of them to actually have exposures in certain specific sectors. Yes, I mean we try to actually balance the in-house management as well as the external management. But for asset class that we don't have strong expertise in or we don't have conviction in, we tend to outsource them. Clive.
Okay, and just one more question to you, just on this. In terms of your move out of domestic assets, how much of that is going to stay within Asia, and how much of it is maybe going to be more into global markets?
Well, I think as I mentioned earlier, we want to move that. I mean, generally, we want to move our allocation into to the 30%. Predominantly, our exposure currently is in Malaysia. So we want to have a footprint not just in Asia, but also in the developed markets. Asia was the first natural progression for us when we started back then, but increasingly we want to be able to have exposures across the asset classes, across regions. So Asia is naturally would be a straightforward preference for us. But we do want to balance it with the other opportunities across the globe, Clive.
Okay, thank you. Now, just in terms of running your portfolio, how much do you make decisions based on geographical issues, or is it mostly just based across different asset classes and the value therein?
Well, it has to be both. I mean, hearing the Quap story, I mean, our story over the last 3 years, in terms of what we'd call the transformation from being predominantly an IG and credit shop to being a sophisticated multi-asset class, liability-driven investor, started with derivatives, as I mentioned, and in our biggest book, we use derivatives extensively to neutralize our interest rate risk. And what that allowed us to do, I mean, which is why, I mean, it's interesting actually, if I can just offer an observation or an editorial on even this discussion. Every investment view that we have should be factored back into the context of your investment objectives, right? And I mean, it sounds so basic and 101, but everyone forgets that. I mean, and that's why I wanted to jump on. Within what context is Asia equities a no-brainer, right? We didn't spend enough time on that subject, but maybe coming back. So the way we walked towards improving our asset mix, first of all, and then we had a geographical angle, which I'll get into, was that we neutralized the uncertainty that we had in our portfolio, which was the biggest, if you put it in order for an insurance company, a life insurance company, is interest rate. So by predominantly neutralizing interest rate, my boss will always tell me it's not gone away, but basically by neutralizing that, we then were able to focus on our growth portfolio, which was largely liquid equities, right? So we've been following the same approach, you could argue a bit late to the party, of diversifying our growth assets into illiquids, right? So there's an intended proportion, which is quite significant, of our growth assets that will be in illiquids, and we've been ramping up. We set up a VCC structure, we bought teams, we're focused on private equity, private credit, venture capital, and indirect real estate, and we've massively been ramping up our private asset and illiquid exposure over the last couple of years, and that will continue for a couple more years. And so what that allowed us to do, I mean, there's a couple of benefits of entering into the illiquid space. One is the impact on volatility, which we are attracted to. Right? We can see through it, but we basically like that, and the illiquidity premium, right? So, and particularly in the asset class space, so private credit versus liquid credit, and private equities versus liquid equities. So that was a move into new asset classes, and then within the existing asset classes, yes, our theme. We've had a domestic bias, which in the countries around the region would be local first, then Asia, then global, right? So very little global. We've been on a path for the last 3 years of moving away from domestic and Asia to global, right? And we accept it, and that's a strategic move, right? So we believe that the global markets are deeper, will offer a better ability to achieve our assumptions in terms of equity returns, which are no more complex than equity risk premium plus risk free. So in order to achieve that assumption, go global. And then within a tactical perspective, with, say, a core allocation to the largest markets and the biggest themes that we think are long term, it will be whether we tactically tilt. So, this year, and China's rallied quite a bit already now, but this year, moving out of Asia in favour of global may be something we slow down. Our deployment into private assets have slowed down, right? And given where we're funding them, but that's more of a tactical position. The strategic position is we want more global, we want more illiquids, we don't necessarily want much more credit, and certainly not credit duration, and certainly coming from where we were, but short-term spread. So alt credit, so high yield, leveraged loans, securitized assets, even trade finance and other banking type assets, ABS. Those are the areas where historically we weren't playing, and now we're playing more.
It's interesting because so many conversations that I will have with investors will come on to the subject of liquidity, and investors being spooked by and concerned about the lack of liquidity. But you're moving into illiquid assets, but at the same time keeping, you say going global. So is that to keep some assets in more liquid?
Yes,
as well.
Our theme around liquidity. We're still in growth phase in all of our markets, right? I think some Southeast Asian markets are going through a cycle, but generally growth. So we're net receivers of premiums. We're net investors in markets, and so that significant amount of cash flow allows us to be less concerned about liquidity at an operational level. But what we've also been doing in our portfolios, and again, it's linked to derivatives, is unfunding some of our exposures, so moving from cash to derivatives instead, not for leverage, but basically to sit on a stock of cash. And that's been necessary. You touched on the UK LDI issues. That's been necessary to support our derivatives program. It's self-reinforcing, right? So the need for liquidity, this is internal liquidity, has been paramount and been one of the top agenda items throughout this transformation. What's interesting about private assets is, you make a commitment, and some people who are savvy in the private asset space overcommit, right? So they basically, and the reason why they do that is they know that there's a drawdown profile to the investments that they have. So, and this is one of the other points that's been quite interesting for us in terms of assessing returns in the private and illiquid space, because all private managers, I'm sure there's a few in the room, talk to you about IRR. You can't eat an IRR, right? And as an asset owner, you're still looking at time-weighted returns, right? That's time-weighted returns on deployed assets. It's not on commitments. So the difference between commitments and drawdown profile is what gives you the illiquidity issue. And the overall amount of illiquid assets that we're intending to be exposed to is well within our liquidity tolerance from an overall portfolio perspective.
Okay, thanks, Trevor. Just to come on the liquidity subject to you, Ashwin, as well. Obviously, there are still few deep liquid Asian markets, but where can you find liquidity if you need to? And are you confident there will be more liquidity, that these markets will offer more liquidity going forward?
Oh, absolutely. I think in terms of where existing liquidity is, you can't walk away from China, Hong Kong. That is by far the most liquid market. And the Asia market's inclusion factor is still a fraction of where it should be in time. So that will dramatically increase liquidity, right? The value traded in China is north of $100 billion on a daily basis, right? So it's substantial. And the rest of Asia collectively is a third of that. So there you have it, right? So that's really where the constraints come from a liquidity perspective. But what we're increasingly seeing is there are industrial parks that are being put up because manufacturing is moving out of China, or at least there's a China plus one strategy, and the Dells have done it, the Apples have done it, the HPs have done it. Everyone's looking at a China plus one strategy. And a lot of that's moved to India, it's moved to Vietnam, it's moved to Indonesia. So a lot of pension money is investing in these industrial parks because these are long duration assets. It's, you get some sort of reasonable rate of return. and you can put sizable amounts of money to work. I mean, the Morowali Park in Indonesia, for instance, which is to extract nickel and build batteries for electric vehicles. I mean, it's an $18 billion project, and it could collectively over the next decade be something like $60-70 billion. So there's a substantial amount of money that you can put to work in this. The liquid space is a trickier space for sure, but we have seen listings even in ASEAN in terms of the tech space, right? There's Sea, there's Gojek and GoTo now and Grab. These are all listings that weren't there 3, 4, 5 years ago, and these are large cap liquid names. So there is a lot of that happening. You are seeing greater sector variety as well in terms of the new listings, because India, hitherto, you looked at banks, you looked at consumer, and you looked at IT services. But now you've got a very large consumer space, which has also tech names. And when we say tech, I mean not IT services, but more in terms of e-commerce, payments, fintech, that kind of stuff. So you are seeing that, but it's still work in progress.
Okay, thank you. If you've got a question, have a think about what you might like to ask. I'll come to the audience in a second. But you mentioned China. I thought it would just be useful to go round the panel and just get quickly the views on China and the investment case for China. Yogesh, maybe start with you.
It's obviously very timely with the opening up, which I guess is a surprise on the positive side. So deep, unavoidable market with the upside. Absolutely. I think you have to understand the market if you're entering China. So I think, now my portfolio is my portfolio. So it's very, very different from managing other people's money. So I don't understand China, but I definitely see the potential. So I think there's a question of getting to know that market and seeing the potential. And of course, there's still lots of risks, right? I mean, China, the lack of correlation with other markets is attractive, but it also reflects maybe certain idiosyncratic issues, including, for example, I shouldn't use the word caprices, but left field kind of events such as the regulation in education and tech, right, and or seemingly justified, but these are really big events, and so there's that. And of course, I don't think the property issue has gone away. So I think long term, going back to the simple factors driving returns growth, I don't think China's growth slowing from a high base, as Prakash was saying, but it's still going to be the major single driver of global growth, right? As growth declines, the base increases, the contribution to global growth remains in that 40% range that Prakash said. So I think you just can't avoid it. Just think you have to make a big investment in understanding where the opportunities are.
Yeah, Ashwin, from your point of view, is it sort of pick carefully? I mean, you
yes,
you guys said, I mean, you're probably not buying Chinese property stocks at the moment, for example.
Yeah, I mean, so for the longest time, we've stayed away from Chinese banks, and we've been extremely selective in property, and that's funny, and in direct contrast to virtually every other market where, well, even in China, banking is the largest sector, but in terms of listed market cap, almost everywhere else you'd struggle not to own a bank. But in China, it's been the right call to make for the better part of a decade, right? What we find is, with all the caveats that Yogesh has highlighted, and then they're all absolutely relevant, you must understand that China is a walled garden, and the government is okay with you earning supernormal returns until the industry reaches a point where it's happy with it. So you basically look at any industry and say, okay, eventually your returns are going to be 10% cost of capital plus or minus, right? That's it. So if you're in an industry that's nascent, which the government's clearly pushing, you are okay earning 30% return on capital, but you should be, you should have one eye on the fact that at some point in the next decade, you're going to go from 30% return on capital to a 10% return on capital business. And that's where I think people have been caught napping over the last 5-6 years. And I think there are enough industries. I mean, the whole clean energy space, the automation space, the robotic space, even healthcare eventually. I mean, we sort of glossed over the fact that, aging population in China, but typically what happens with aging populations over long terms is money moves from consumption into healthcare. And that's a big space that you can invest in China as well.
I certainly remember talking to lots of investment bankers who would tell me 3 or 4 years ago that they had long lists of future biotech stocks that were going to list in Asia from China. They haven't seen so many of those yet. I mean, Trevor, for AIA, obviously Greater China is a very important part of your business, isn't it? So how does that impact your view in terms of investing in China?
Yeah, that's right. So there's two angles, right? And China's one of the powerhouses of our entire growth. So there's a domestic angle where the focus is really about assets and largely in the private space. But how do we, there's a very small group of asset classes that you can invest in domestically, and so expanding that is basically our focus. So more credit, alternative type credit structures. And private equity and private assets more generally, infrastructure, real estate, etc., is a big focus onshore. And then offshore, as I said, from a tactical perspective, we've been pro-Asia now, or turned pro-Asia in the last couple of months. We've been in an equity underweight position, so it's still not pro-equities, but basically within equities, we're pro-Asia versus the rest of the world. And fixed income, I mean, we're big buyers of Chinese debt. We don't yet think it's the time to, I mean, a lot of that's real estate related, and so we don't think that it's the time on into real estate again. But we're still quite large buyers of offshore of Chinese bonds. So we see a lot of just in terms of the backdrop in China. So China was one of the only countries. I mean, there were a couple in the region that had rates falling this year, right? So that was beneficial for our offshore holdings in government bonds, particularly, and clearly there's been movements on the currency. Looking out from where we are now on the 12-month view as a foreign investor, do you think that there's really much more to go on either? Potentially, the growth story will support the currency, but not necessarily the rate story. So that's why we're looking again at the fixed income side in China.
Okay, thanks, Trevor. Nazar, what's Co-op's approach to Chinese investments?
Thank you, Clive. I think internally we've had quite a interesting debate in terms of our expectations for China. I think from a tactical standpoint, we are more optimistic on China, but I think there are some concerns in terms of how does the China-US relationship pan out going forward. The geopolitics side of things is something that we are also wary of, but from a strategic standpoint, long term, we are fairly optimistic on the prospect of China. Is the largest, economy, arguably. And given the role in the region, I think it's something that we have to have exposure in. Currently, we are pretty much exposed through equities, through that asset class, but hopefully we can build the portfolio around other asset classes as well. So short answer again, tactically, we are pivoting towards slightly more optimistic and overweight stance on the Chinese market, given what's happened in the past few weeks.
Okay, thank you, Nazar. Time is moving along very quickly here, so let me come to the audience. If there are any questions from the audience, please don't be shy. Put your hand up and ask away. We've still got a shy group of people with us at the moment. Okay. Oh, we have one back here. There we go. Chris Wright, I knew I could rely on you.
Thank you, Clive, and thank you everyone for that presentation. It's been really interesting. I'd like to ask a question on private markets, if I may. A huge surge of capital in that direction. You may have seen the Invesco report recently, which shows that sovereign wealth investments have way more than doubled over the last 10 years into the private markets. The research you just showed, Clive, and the comments from Nazar and Trevor demonstrate that there's still more capital wanting to go that way. It strikes me that two questions come from that. One, and this is particularly true of infrastructure, is the capacity of those asset classes to absorb the capital that wants to go there. I'd be interested in your views as to whether the right assets are still there at the right price for you to port where you want it to go. And the second is how this probably applies more to private equity, how the performance and the valuation has changed as we've gone from a risk-on to a risk-off environment. Still huge sums of money in those areas, but how is its behavior changing? Thank you.
Thanks, Chris. Well, let's go to two of the panelists who have talked about investing more in these areas. Let's start with you, Nazar. Did you hear that question okay?
Yes, I did. I think for us is trying to build. For us, I think we are slightly behind in terms of our allocation into alternative assets. So the strategic imperative for us would be to have a bit more exposure. We're not even neutral. I mean, we are below what we intend to go. So naturally, over the long term, yes, I do appreciate the concerns in terms of opportunities and massive amount of capital flowing into the asset class. But we do think there are pockets of opportunities that we can potentially participate in. And I think the private asset class is quite large. In our context, we have private equity, we have infrastructure, we have private credit, and as I mentioned also real estate. So I think there are still opportunities abound for us, and we don't move overnight large sums of money. We take a measured and a patient approach in terms of building a portfolio. As mentioned earlier, we are also curtailed by certain restrictions. But based on what we've been doing so far, I think there are opportunities for us to even now to participate in those opportunities. So it's a natural progression for us, and it's a conscious and deliberate strategy on the part of the fund to build a portfolio within the private markets. So that's my response to that question.
Thanks, Nazar. Yeah, thanks. I'm trying to just, obviously you said you're moving to a lot of liquid assets, moving into private equity. How do you feel about the valuation, particularly maybe in private equity, where of course, private equity companies are facing increased cost of the debt that they carry in order to invest in businesses. So is that something that concerns you?
The short answer is it doesn't concern me. But I'm thinking about the most concise way to answer the question. So yeah, we funded all of our private asset investments out of our growth portfolio. So we have a 10% net US dollar target return. And so private equity and venture caps meant to, if you look at any capital market assumption, it's meant to pay there or higher, right? So we rely on skill of the managers to defend ourselves from the fact that, yeah, we do think there's too much money chasing these opportunities. And I think the nuance in the numbers comes back to this point about commitment versus drawdown, right? So someone raises a 2 billion fund, they've got 2 billion in commitments, they may not ever draw that money, right? And they draw when what's interesting about PE is they fund through debt normally to manage the IRR, right? And then they draw down in a way that's optimized for them to hit their IRR targets. And I think that's an issue, right? In terms of a disconnect between what investors expect to receive and how much money they have put to work and what return they get on that money, right? I don't think there's many good metrics for that, and that's what we're concerned about. I think that goes to the second point. Because we funded our and the easiest way, and as I mentioned this point about the oversight and the governance hurdles that you've got, by funding out of growth assets, we had higher return targets. I think where the interesting space is, to your last point, Clive, I think lending and credit underwriting to PE funds, especially given banks have tightened up on their activities in that regard, has led to massive opportunities in private credit, right? I mean, and that's really interesting, exciting. There's clearly some risk in there, but I don't suspect that it's as risky as the investments themselves. So those would be my comments. I think there was a second part to the question. I did have. Yeah.
Well, we're running out of time quickly. We've got a couple of minutes left. Just before we finish, it was great to have investors on the panel here obviously ESG is a big topic. We haven't really touched on it too much. So I'd just like to ask each of the panelists, certainly on the investor side, I'll get you guys to then sort of finish off with just his views on the growth of sustainability in Asia. But each of the investors, just to give us a 1-minute overview of what their approach to ESG, layering it into investment decisions is. Ashwin, maybe we start with you on that one.
Sure. So the way we're looking at it is ESG has been, at least in this part of the world, they've basically tried to port over a construct that was working in Europe or the US, and they're applying it to Asian companies, which doesn't work. So the way we are looking at it is, look, the reality is 80% of power in Asia is dirty, and you can't walk away from that. So essentially, the way we look at it is, Europe, whatever you are today, that's your baseline. If we can put hand on heart and say, we see a path to you getting cleaner, better, whatever it is, over the next 4, 5, 6 years, which is whatever the investment horizon is, we see a case to buy the company. So that's the simplistic view. That said, we're also cognizant that, look, I mean, the world cannot decarbonize without solar, wind, electric vehicles. And the bulk of that value chain is in Asia, globally. So yes, some of these businesses are dirty, but because they have to be done, you just have to be, you have to close one eye and look at it. So, but the way we're looking at it is essentially that we integrate that into the fundamental research of the company. And if we can make a case for a fundamental improvement on ESG criteria over our investment horizon, we rate that company favorably.
Okay, thank you. As we are short on time, Trevor, just quickly on your ESG investment approach.
So there's ESG and net zero. And so net zero has become the key focus. ESG, I think, as you say, I think there was a lot of rhetoric around it. There was a lot of rushing towards it, and then now a lot of deciphering what really can be done, what can't be done realistically. Whereas the climate transition agenda, which again now is top of agenda for most people, is quite interesting and feeds back into the same point in terms of because as an investor, it's how our underlying companies have committed, and then what are they doing to transition that the scrutiny's on. And so for us as an asset owner, it seems our biggest role to play is stewardship, is advocacy through proxy voting and influence on companies, right? So that's an area that comes in and out of focus, but is a key area of focus for us.
Thanks, Joe. Nazar, just quickly as well, on your approach to net zero, sustainability, ESG, and being active as well as Trevor mentioned.
As a philosophy and a conviction, we believe that ESG can generate returns over the long term. As an investment, as a pension fund, we believe in that. But I think we just like to push the dial a bit higher. We are looking at ESG from a sustainability standpoint, both from organization as well as investment. So in terms of our approach, currently we are focused on engagement and stewardship. But we intend to actually integrate the bulk of the ESG best principles that best fit us as a fund. It's easy to actually adopt best practices that Ashwin mentioned about European model, but I think it's always good to look internally and see what's best and the things that we can adopt as a pension fund. So that is the premise in terms of how we look at ESG and sustainability, Clive.
Okay, thank you, Nazar. And then you guys, just our last sort of summation. I mean, it's interesting, isn't it? Net zero doesn't happen without Asia playing an enormously important role. How do you think Asia is doing?
Okay, I'm gonna duck that and go to the second part of your question. This whole space, right? I mean, the ADB estimates something like 1 trillion investment needed in Asia, right? Much in China, but a lot of that is green. So I think that offers a tremendous opportunity for investment. And to kind of to your point, I think the trend to alternatives continues, infra, real estate, etc., illiquids for the reasons Trevor said. And I think we might be able to generate those assets, but I think we need better mechanisms for public-private partnering to deliver the funding, and also, I guess, to nurture the right projects.
Okay, thanks, Yes. And then there is a session this afternoon on sustainability net zero. Do please listen into that. In a moment, we'll have our next panel. It's another group of investors that are very interesting to OMFIF about ultra high net worth investors that my colleague Lily Zhu will be chairing. But as Lily gets ready to come onto the stage, please put your hands together for our panelists, and thank you all very much indeed for taking part today.